Before we talk about emerging nations, let's talk about U.S. and China, because in recent years, the story's all been about U.S. and China and the strength of those economies. Why is that not going to continue?
Well, I think, David, if you look at the pattern of economic history, what you find is that when nations do very well in one decade, it is very hard to repeat that kind of success in the subsequent decade. And the last decade, as you pointed out, really belonged to America and China. America emerged from that as a financial superpower in a way that it almost never was. As you well know now, that 90% of all transactions in the world are done through the US dollar. As a financial superpower, America reached new heights by the end of the decade. And China, too, had an amazing decade with its share in the global economy expanding very rapidly. But I think that both those nations now are going to hit or are hitting some significant roadblocks. In China, we're seeing the challenges of demographics and debt. For the first time now, the Chinese population is beginning to shrink. I think that's a huge development. And there has been no growth story that has been able to sustain itself where the population of a country is shrinking. And China is now exhibit A of that. And the United States, I think after a great decade, I wrote a lot about how the US was going to be the comeback nation of the 2010s. The US seems pretty overstretched as well. And the way it has weaponized the US dollar just now in the fight against Russia, I think will also have consequences where the rest of the world is fighting or looking how to get off this dollar standard.
So, Ruchir, that explains why perhaps the United States and China won't do as well in the next 10 years as they did in the last. What makes us think that the emerging markets are in a place to pick up the slack?
Well, I think there are a couple of things going on for emerging markets here. One, I think it's really important to put this in perspective that these emerging markets that we're talking about, whether it's India, Indonesia, or even the likes of Eastern Europe, these countries did not have the resources to spend that much on stimulus when the pandemic hit. So these countries really were forced to carry out some more fundamental reform. In India, the priority seems to have shifted again towards economic growth. They're focusing more on issues like privatization. Indonesia, they're changing the labor laws. So I think what you're seeing in emerging markets is the difference between stimulus, which the Western countries adopted in great measure, and in emerging markets, which did some stimulus, but not to the same extent. So they were forced to carry out more productivity-enhancing reforms to try and revive the animal spirits. So I think that's one very important factor. The second has to do with commodities, that if you look at the history of emerging markets, typically emerging markets do very well when commodity prices rise because so many emerging markets in Latin America, Middle East, Africa are big exporters of commodities. And one of the big themes of this decade, which is shaping up, is that we seem to be at the start of a new commodity supercycle because we cut investment back so sharply in commodities. And now it seems as if demand's going to still be strong for commodities, even for building a new green infrastructure, yet the supply is being severely constrained. So I think that that's why this could end up being a pretty good decade for commodities, and that's very helpful for many emerging markets.
Ruchir, as you know very well, there isn't just one class of emerging markets. Each one is quite different than the other. Take the two things you just talked about, reforms on the one hand and commodities on the other. Which are the particular emerging markets that might benefit from one or the other, or maybe both of those?
Yeah, so I think that you have countries such as Brazil, Saudi Arabia. I think some of these countries could do quite well compared to expectations. I think the important thing here is that the expectations have been reset. And so no one expects these countries to do very well. But some of these countries could do quite well because they're so dependent on commodity prices. And now you have commodity prices going higher. Even in places like South Africa, the domestic demand could do quite well if the mining sector revs up again. Now, in terms of the sweet spot where the country could benefit from both, possibly a country like Indonesia, which has both commodity exports and has also carried out some economic reforms. So I think these are some of the storylines in emerging markets that could do quite well in the coming decade.
Ruchir, you have a piece in Foreign Affairs, the current edition of Foreign Affairs, that struck me when you did a comparison of the extent to which the U.S. and China occupied the global market or the global economy as opposed to the value of the stocks, and how that compares to emerging markets that would suggest that perhaps the US is overbought. Go through those numbers.
Yeah, I think that this is the extreme value trade out there, so to speak. But if you think about it for the next 5 to 10 years, so here's the snapshot. The United States today is roughly about 26% of the global economy. But the US stock market today is over 60% of global stock market capitalization. That's a huge gap that's opened up, a gap that was never there. At the start of last decade, the number was 25% of global economy was the US share, but the share in the stock market, global cap, was about 40% or so. So massive gap has opened up out here. Now, some people say this is because the US has so many global companies. Even adjusting for that, the US share in global stock market cap is over 50%. I think that's far too much of an allocation of capital towards the United States. At the other end of the spectrum are emerging markets, especially emerging markets outside of China, which account for more than 20% of the global economy, but their share in the global stock market capitalization is well below 10%. So this, like for me, represents a lot of value out there, which is that a lot of capital is allocated towards the United States. The United States is very expensive today as a stock market. In fact, the US stock market today, compared to the rest of the world, is trading at a 100-year high. That's a very wide gap. And emerging markets are at the other end of the spectrum. Historically, they're very cheap. The currencies are also quite cheap, and their share in the global stock market cap is way below their economic weight. I expect this gap to close in the coming decade.
Ruchir, let's talk about some things that could hold back emerging markets, and particularly the commodities that you referred to that are good on the upside when you're selling them. On the other hand, these emerging markets need energy and they need food as well, and often they will subsidize that for their population. Could that hold some of the emerging markets back?
Yeah, the thing about emerging markets is that there are about 150 developing countries out there. There are only about 40 countries that are classified as developed. So there are 150 developing countries out there, and there are many storylines there. And there will be some nations which will bear the brunt of higher commodity prices as well, which are large importers of these commodities. The turmoil we're seeing in Sri Lanka, in places even like Pakistan. And then also we have in places like Peru, which should be a beneficiary of high commodity prices, but currently a lot of protests are taking place because of higher energy prices. So there will be some countries which will get hit by that. But on average, if you look at the history of development economics, what it tells you is that the decades when commodity prices do well tend to be the decade for emerging markets. I would say that emerging markets tend to do much better with higher commodity prices than lower commodity prices because they export so much of raw materials and energy.
One final one, Ruchir. What about how they deal with increased interest costs? Because there's a lot of external debt for a lot of these emerging markets, and it looks like interest costs are going up.
That's true. Now, the couple of counters I have to that is that one, that many of these emerging markets have already increased interest rates. So unlike the Fed and the Western central banks, these emerging markets are somewhat ahead of the curve rather than being so behind the curve. So that shock has been partially absorbed. The second thing is that they've become much less dependent on foreign capital. The key thing to remember is this: 150 plus developing countries out there. There will be many storylines, but on balance, if you look at the picture, and especially the relative picture compared to the US, which has also taken on a lot of debt, the prospects for emerging markets look much better than they did a decade ago. And the US is the mirror image of that.